I guess what we're going to talk about today is my experience with building my company and ultimately getting to a point of exiting the company. And maybe we'll talk about some private equity, my thoughts on kind of what that landscape looks like. But in a nutshell, I started a carpet cleaning company in 2011. And, obviously just building the company, figured out a way to get off the truck and start working on the company as fast as I could. And that company is Pure Clean Carpet Cleaning. And I built.
Where was it?
This is in Washington State.
Washington State. Okay.
Yeah. I mean, I went through a bunch of stuff, right? So I got in my past life, if I'm kind of explaining my whole story, is I was a kid that grew up in Woodville, Washington, and my dad was a window washer growing up. So, single operator, kind of a lower income family. We had enough to get by, but certainly not experiencing any of the good things in life. Wound up getting in trouble a lot growing up. My story is that I got kicked out of every school I went to. I got arrested 27 times. I've spent a lot of time in jail. I've had a very colorful life. I lost everything in 2008 to bank, the mortgage crash, because back then I was doing mortgages, feeding kids out of the dumpster. So I've kind of experienced all parts of life, the highs, the lows, the everything in between. So just wanted to give you that kind of background to explain to you. So when I lost everything in the mortgage market crash, I had to figure out a way to make money immediately. Is anybody gone through that? It went through the crash and lost everything back then?
A lot of people did.
And so the mindset was really just, what can I do to start earning money immediately? And what made sense at that time is that my dad had a carpet cleaning truck available to him that he had used in his prior business that he had shut down years prior. So I grabbed that truck and I just started going door to door, and that's how I started the carpet cleaning company. I really had no intent on being a carpet cleaner, but that's just what made sense to me. So I built that company up to about $3 million in revenue, and it was a good company, right? We were putting out 25% net margins. I was doing that, and then in 2017, I had the opportunity to enter into the world of water damage restoration. I was approached by a guy that wanted to sell his company to me, and I had no idea about buying companies. And you can tell by when I finish this story that you'll see what lack of knowledge can do. But he came to me, he said, "Let's grab beers and talk about you taking over my company, and I'll work for you as your mitigation manager," which is basically running that department. And so long story short, I wound up acquiring that company from him, which was Clean Green Restoration. And overnight, I was now in the water damage business. And my experience in buying that company was the lack of due diligence. What it resulted in was he had racked up a ton of Department of Revenue debt that I didn't know about, to the tune of about $316,000 that he owed in back taxes. I had no idea, didn't know how to underwrite a deal. And what wound up happening was I had acquired all of his equipment. I had acquired his employees in the acquisition, obviously, and his phone numbers and website. But one morning I came in at, typical 6 a.m., got to the shop. I walked in the back door, and all the equipment was missing off the shelves. And so I got excited but nervous in the same time, because part of the excitement was we had a big job that came in. The nervousness was that seemed unusual, that I didn't know about it. So I called Frank, the marketing guy, and I asked him if he had talked to Steven, because Steven was the guy that I acquired the company from. And he said he hadn't heard from Steven. And so I called Abraham, the other guy in the business, said, "Hey, did you hear about a big job coming in last night?" He said, "No, I haven't heard anything." I kept calling Steven, no answer. So I got this weird gut feeling in my stomach, pit in my stomach. Went upstairs and checked the security footage, and it turns out he had showed up at 3 a.m. with a U-Haul truck, loaded up all the equipment, and drove to Utah.
Oh,
and And so at that point, I had a business that I didn't understand because I had hired him to run the shit for me. But I had a phone number with jobs coming in. And anyway, and then I found out that I owed a bunch of money to the Department of Revenue that I didn't know about. So that was my first experience buying a company.
How big was that business? What was the revenue?
He was doing about $1 million a year in revenue. And again, I was such a rookie that I to me, all that made sense is I can buy your equipment. You'll work for me. I like the industry. Let's do it. You know?
So
And
you
so
paid for the equipment?
yeah,
So how much you paid?
I paid him 179 grand for all the equipment. So it was an asset purchase to buy his equipment, and then gave him an employment agreement to pay him 100 grand a year salary and with some bonuses and such. But anyway, when he disappeared, all of his employees that I had acquired, the construction manager, the marketing guy, and the 4 technicians all left the same day. So I stood alone in that industry. And so fast forwarding, when your back's against the wall, you can do some pretty amazing things. So instead of closing down the business, which is what I was tempted to do, I just immersed myself in it. And for a period of probably a year, I worked around the clock, literally around the clock. So I'd go out all night doing water damage, show up, run the meetings for Pure Clean, get everybody out the door, and then be catching up on invoicing during the day. So did that for a while, and wound up building. The end result was I wound up building an Inc. 5000 5 years in a row company. PureDry Restoration's the largest and most highest rated company in Washington State for water damage restoration, which is pretty exciting, you know, to have done. What the success landed me was, which we all know, in 2021, 2022, because of us being on Inc. 5000 and, you know, all this stuff, we just started getting a lot of inquiries about selling the company. And I never really intended to sell the company. It was a family business, you know.
What's the revenue at this time? At
So at the,
2021, 22?
At the time that I actually sold my company, I think we were doing 16 million in revenue.
Okay. And EBITDA?
We were doing about 3 million in EBITDA.
Okay.
And anyway, so my experience was that I decided to hire an investment banker, and I've got a thing I can send to everybody, which is the 7 things I wish I knew before I sold my company. But I wound up hiring an investment banker to represent me and take me to market, which was the smartest thing I could have done, because I had a lot of interested people, meaning direct communication with different private equity groups. And because I hired an investment banker, I wound up doubling, if not tripling, the amount of revenue, amount of money that I got when I exited my company. So when they brought us to market, we got about 47 letters of interest sent to us from different private equity groups. That turned into, I think, 27 legitimate letters of intent. And then we basically reduced that down to our top 4 and got them competing against each other to the point where we narrowed it down to the top 2. So the one of the companies said, we want to take him off the market. We want to know what he wants. Give us the number. And we gave him the number and went exclusive with this group. And that's when the work began. The work beginning, meaning just the quality of earnings and the due diligence process to follow. And
what was the number?
So it was a $40 million offer, no earnout, cash at closing. And then I was pretty intentional about making sure that I had the opportunity to roll part of that forward, and I wanted to roll a much larger amount than they originally wanted to.
Wow.
And so I was able to negotiate and make sure that I could roll 10 million of that 40 into buy about 7% of the group that wound up acquiring me. because I was very bullish on the market, and I was very bullish on them and my abilities and such. So that turned out to be a very, very smart move. Obviously, because they're going to be selling. Well, it'll be public information, but they're getting ready to sell right now for a very large dollar amount. That's going to create a very large second bite for me. So that's going to be a pretty exciting time coming up in the next 3-4 months here. So
That's awesome.
yeah.
And so as you were talking to all these potential buyers, what kind of made you lock in on these guys?
A lot of private equity groups are you're either going to be acquired by a strategic, or you're going to be acquired by a non-strategic, meaning somebody that wants to get into the industry and kind of build a platform on you, or maybe already has a platform that they want you to come into. But for me personally, it was just about, I wanted to make sure that my brand was going to stay in place. I didn't want to throw on a different uniform. I didn't want that would have been really bad for me. And so that the specific group that I went with made sure that you could operate your company independent of their overreach, and they were founder friendly. And that's what founder friendly really means, is they're going to allow you to keep your brand, keep your systems, keep what made you successful. They're going to allow you to continue in that traditional sense. Where a lot of these groups, when they acquire you, they're going to change your whole playbook and really change a lot of your operating systems. And I just didn't want to sell to a strategic, which would have been a larger water damage company. For example, it could be ServPro. I didn't want to sell to a ServPro or something like this. Yeah.
And are they so when you're as you're negotiating, I'm taking a step back, were the offers right off the bat all cash, no earnout, no roll up, or you had to negotiate that, where you negotiated all cash and then decided afterward to roll some of that cash into equity?
I think we had 27 offers total. And so when you got the offer deck, it says company, what their offer is, and all this kind of stuff. The offers range from 14 million up to 31 million, I think, was the highest offer in the entire deck.
Okay.
And we wound up taking those people that were in that 28 to 31 million and stacking them against each other. And then we were able to get them all the way up to 40 million by doing so.
Okay. But the terms, so the price is the price, but the terms they're all similar.
Oh,
and
yeah.
They're all cash.
Yeah. So the group that we were most interested in, that they were very upfront about that. They said, look, there's no earnout. You're going to get 100% of cash at closing. There's no midnight, changing the deal. That's what we pride ourselves on, because you hear about that in private equity. They do want to burn you out. I mean, let's not kid ourselves. They want to burn you out mentally and get you to a point where you just want to be done with it. And so you wind up dropping your pants to some degree. But they honored their word. They said, we're going to give you that dollar amount, and we're not going to change it on you in the 9th inning. And that turned out to be true, but it's not true for everybody. In fact, a lot of people I talk to, they get the rug yanked under them at the last inning. And they use certain due diligence and certain quality of earnings things to do that typically. But anyway.
Yeah. So how was that due diligence process with the private equity? So can you walk us through it, and then some of the issues that you end up having to resolve?
Well, in my 7 things that I would recommend to somebody is, if you go to market, you've got to be completely staffed up and prepared for it. Because if you miss a beat, when you're in quality of earnings, and by missing a beat, I mean, if your revenue drops at all, you're kind of fucked. Like they're gonna reprice the deal. So you, as the guy selling the company, you've got to be running that. You've got to make sure that your company is continuing to hit. And so you got to make sure that you've got a very good controller and a very good bookkeeper, because they're going to be crucial to the deal. I was lucky enough to structure my team in preparation so that my controller and my bookkeeper could 100% focus on the deal. and all the quality of earnings stuff, and they hit you with a ton of stuff. I mean, it's an IRS audit, you know,
Yeah.
with groups this big, they hire the big accounting firms, and they want to come in and just tear everything up and look deep, deep, deep. So that's the big thing. I was able to continue focusing on making sure we didn't miss a beat, because that quality of earnings, not for everybody, that's going to be probably a 90-day period of time. And they're basing their price off a trailing 12-month. So if you miss a couple beats while they're doing their quality of earnings, they're going to want to reprice the deal. So make sure that you got a good solid team under you that can handle that. And so lucky for me, I had that team. The other thing that I think allowed me to get a very high multiple, I got a higher multiple than anybody had seen in my industry for my size. I strategically hired a COO before I went to market to give the appearance, at least, that this company fully operated without me. That drove the multiple up, because they, you know, some of us buy companies, so you would want that, but some of us are looking to sell. And if you're looking to sell, you've got to make sure that your executive management team looks like they can run this thing without you, because that's going to drive your multiple up. You know, and I can keep going into.
Yeah, keep going. Yeah, keep going.
So I think the process really starts with them just get access to your books, obviously. So they're going to be having their big accounting firms dig in and go 3 years back and question every piece of revenue and every write-off. Obviously, any owner benefits that you did, taking money out of the company and wanting to know why and what. But frankly, like I said before, I tried to stay out of that. I said, Diane, my other piece of encouragement would be to make sure that your books are very clean. A lot of companies that prepare to sell, their books are in no way or condition ready to sell, and you get ripped apart, and it becomes a lot more stressful. So I think if you're going to be entertaining wanting to sell, I think it's bringing a consultant in prior to that and making sure that your books are in such a condition that quality of earnings really isn't an issue. Lucky for us, we had very clean books. Our chart of accounts was very clean. And I was very knowledgeable about our P&L and our balance sheet. You know, we had an answer for every question that they gave. So preparing for that and kind of, I think, can make quality of earnings and due diligence go a lot smoother than if you don't prepare for it. Because, you know, it looks weak if you don't have an answer for why your revenue dipped or what happened here. And so going back a couple of years and looking at why your revenue spiked or why it dipped, and having a very good explanation where you're not stuttering, you know, and clearly trying to like think on your feet. You want to have a knowledgeable answer to it. And even if it's not a good answer, being knowledgeable and confident about your answer really goes a long way. And that's that, you know, they're going to go through it. I also sold myself. I'm a salesman by nature, and I think I really sold who I am and the type of leader and caliber that they're acquiring and getting me, not just the company, but who I am. And I think that drove the multiple up quite a bit too, is getting them really excited about having a high octane guy as part of their group. Made them write a bigger number than I think that they otherwise would have.
So in your agreement, were you supposed to stay on for a certain number of years?
No, that was the other thing we negotiated. I didn't want to be handcuffed, the golden handcuffs at all. So my employment contract was simply that I would continue collecting my salary. I had certain bonus opportunities, but at within a 30 days notice, I could put them on notice that I'm leaving the company.
Oh, wow.
And there'd be no penalty. The kicker is that if you're no longer a member of the company, so I'll explain what my new involvement with the company is, but if you're not involved strategically with the company, you cannot continue rolling.
Makes sense.
So I stepped down as the president of the company about 4 months ago now. I hired a GM to fully operate the company, but I'm staying on strategically as an advisor to the company, so that I can continue to roll. As long as I'm an advisor and I'm collecting a salary, I can continue to make large amounts of money. There's probably going to be 2 more sales that occur, so I want to make sure that I'm part of that.
So you're saying by rolling, you mean a portion of your income is you're buying stock in the company, or bonus? Part of your bonus is stock.
Yeah. So when I say roll, so let's just use, raw numbers. I sold for 40. I took 10. I rolled it in.
Yeah.
When they sell again, if I get 50 or 60 million or whatever it is, for tax reasons, and for just continuous opportunity in the future, I want to be able to take and roll another 10 in, but you can't roll unless you're strategically involved.
Makes sense. But that depends on the next buyer.
Yeah, the next buyer is going to have certain things to say about how much the larger shareholders roll forward.
Yeah,
certainly, as they negotiate their deal. Yeah.
So prepping for the sale, when did you decide I'm going to sell and then I'm going to start prepping? Was that in 21 or 2020, or when did that happen?
They did a soft run. So they came into me, the investment banking firm came into me, and they assessed the company and told me what they thought they could get for it.
Okay.
At that time, I had a failing construction department. Like, it was literally in the red, fucking up the entire P&L for the enterprise. And I was wanting to shut the whole thing down. But they said, look, if you can get this construction department turned around and get it into the green, I think it's going to pay you better to have that amount of mix of revenue.
Yeah.
And so they said, so anyway, they presented me with the number, and I said, I'm not going to sell for that number. And I think the number was like 18 million or something. I said, I'm making 3 million a year in my pocket,
Yeah.
So I said, I'm not going to sell. So what they said was, can you essentially double your revenue in the next, because they're looking at trailing 12. So they said, if we went to market in July, do you think you could do it? And when I brought in a consultant, they said the way to do that is to get your construction department rushing, because it's such a top line revenue bringer.
Yeah.
And then try to manage it in a way that you can maintain 15% net profit. And I'm like, dude, I've already tried. And I hated the construction side of it. But anyway, I rolled my sleeves up, and ultimately we made it happen. We doubled the revenue in my company leading up to it. So it just, all things had to hit very specifically in order to get the offer that we got. But it was hard as shit, I mean, during that period of time. And then also to maintain it, like I said, because if you have a glitch in the system, they're going to want to run it back. And
that's 22. You did that work in 22, right?
I sold in November 22.
Okay.
It brought me to market July 2022. So
that was quick.
It was a very quick process. But in their soft launch, I was called Project Wolf, and they brought me to the market to figure out what the market would think about it. And this is the power of hiring an investment banking firm, is that they can really get a lot of insight and inside knowledge as to what the competitive landscape is and what people think about your company without knowing who your company is. And anyway, so that's what it wound up. I told them I'd sell for 28 was the number I wrote down, and they wound up getting 40 out of it just by creating a very competitive buying process with all these private equity groups. And so that's one of my things on the 7 things that you should do is, don't be foolish and think that you can be in a bar room talking with a guy that wants to buy your company and just go straight to deal with him. because you're missing out on potentially international buyers, national buyers, and you're missing out on a very competitive buying process that could double your take.
Yeah.
You know, in my case, triple my take.
It's huge. So let's go through those 7 things that you were talking about. So you mentioned a couple of them.
Okay.
And then guys, feel free to ask questions if you have any. Go ahead.
Give me a minute because I'm gonna have to find it. So I'll go through those unless anybody has questions before I do. So the number one thing that I wish I knew.
A clarifying question.
Yeah.
So when you sold, you were at 16 million, but in a year you doubled it. So you were at 8 million prior year.
We were doubling EBITDA. Yeah, we had to double our EBITDA.
So you went from 3 to 6?
No, we didn't. When we sold, we were at 3 million, at like 1.6 million or something like that in EBITDA before we knew how we could get it. Because he's like, if you want that big of a number, dude, you've got to be in the 3. Because we were talking about multiples, and he's like, think about it, a 10x multiple, you got to be at 4 million EBITDA.
Yeah,
to be getting that. But he said, can you get to 3? And that's when we strategically put together a plan on how we could get to 3 million EBITDA.
Wow.
And show proof of concept that we were going to keep growing, you know, and because they're going to put you in a room and say, you've done well, but what's the future look like?
Right.
We're buying the future. We're not buying yesterday.
That's a big jump. So you didn't have the whole year. You pretty much just showed that you're on track to do that 3 million. And
of course, that became a big topic of discussion. Is it makes them nervous just as much as it makes them excited when you have that kind of growth, because they're like, whoa, could the wheels fall off this bus? Or was this a fluke? Or like, what did you do to get here? So we had to think through strategically what that story looked like and how we got there. And you got smart guys in the room that are sitting down with you wanting to know. But we just had good explanations and a lot of supporting documentation and all that.
They must really want to buy this thing because they were, you know, they're all in. So is this a firm that already had other restoration companies within the fund, or they had other industries within the fund?
Good question. I wanted to be the platform, meaning that I wanted to be the first guy in, and then I wanted to go out and acquire companies and be the CEO of the entire thing. That was what I wanted. Looking back, man, I'm so happy I didn't take. My investment banker was not just a banker. He was like my confidant through the process. So he's really walking me through the pros and cons. And he's like, look, man, it looks like you want to do that, but when you know what's on your shoulders, when you become the platform, I don't think you want that. I think you take the 40 and you freaking ride into the sunset. Because that's what my options were. At the very end of it, I had a platform opportunity, and they were offering me more money than the guys that I went with. Or I could go with these guys, but I was not the platform. I was going to be one of, I think, 6 companies they'd already acquired. And I let my ego out of the room, and I looked at it logically, and I decided I think I made the best choice, you know, in doing that. Because there's a lot of risk. I could have taken that higher offer and been the platform, and then it doesn't work, and you kill your second bite of the apple and third bite of the apple. You know.
So you're part of 6 other companies.
Now I think we have 10 or 11 companies in our portfolio,
and they all run independently, separately from each other.
Yeah.
Are there any shared services at all?
Not really. I mean, we don't have any national strategy, meaning that we have any large commercial accounts that we share. We're all pretty much independently operating, and that was their strategy. They wanted to buy best in class companies in the geographical territories they thought could provide further growth.
Yeah.
And they saw Seattle as being a market they wanted to be in, and PureDry was the kingpin in that market. You know, we had the most reviews, the highest ratings, we had the fastest growth trajectory in the market, and so they knew we were the one.
Wow. Okay.
Hey Ben, when you were talking about doubling your EBITDA and you put together a strategic plan, like was
Mhm.
that adding more people or was that adding more services? How did you do that, or what did that plan look like?
We looked at our profit centers and we figured out which profit centers were going to yield the highest, net margin return. And how could we put more gasoline into those profit centers? And the construction thing, as I said, was um, what I would call an organic growth strategy. I didn't have to go out and open up a new profit center. I didn't have to go figure out how to acquire new clients. I didn't have to do some fancy marketing campaign, because in water damage, as soon as you go in there and you tear the drywall out, they need it put back. And so we knew that if we could figure out the operating discipline of that profit center, we were doing 80 jobs a month in water damage. So if you're doing, I'll just, for rough numbers, doing 10 million in revenue with water damage, you knew you could do 40 million in construction. It was just a question of, do I have the right people in the right place with the right profitability framework? And so that's why, what I mean by strategically looked at it, we said, well, I need the right who. I didn't have the right who that was managing that department, and I couldn't manage it. I didn't know anything about construction, nor did I really want to. So we strategically went out and we found the right who, which is a guy named Nick. We poached him from another company. I made him a good offer, and I said, this department's flatlining. I'm bringing you in specifically to do this. And if you can't show me that you can do that in the first 90 days, I'm going to eject you. I just told him straight up front. And he wanted the challenge. So we brought him in and I said, you've got the steering wheel, but I'm going to be meeting with you, every week and looking at the identify, discuss, solve meeting. We're looking at the scorecards, and so we did, and he started turning that whole thing around, putting the right systems into place. And I said, you're going to need to hire 3 project managers in your first 90 days. So I stacked him with a big chore list of what he had to do, and he knew what the stakes were, and he was luckily able to pull it all off. And I made him a shareholder of the company and took very good care of him for coming in and putting in that work. He's now the VP of the entire company, and he's running the whole show. So that's a lesson to write down, is make sure that you find the right who's, because man, the right who just makes all the difference. I was so focused on doing everything myself and having all the answers for everything and telling everybody what to do. But as soon as I took a step back and found the right who and had him telling me what to do, that's when it really changed our game. And it's been a phenomenal story for him too. Like I said, I made him a shareholder. He'll become a millionaire with this exit coming up. And so all good things.
That's awesome.
Yeah, that's a cool point, Ben. Finding the right person to operate and step in and help is a game changer. Hey, I was wondering, with the water restoration, what percentage of that turns into construction business for you then? Is that a pretty high percentage?
I mean, for us currently, it's about 40%, but it could be 80% if we wanted it. It's just a matter of, do you have the resources? Our challenge was going through COVID, that the supply chains got locked down. We couldn't, if you're trying to order in flooring and it's coming from Georgia, I mean, you're sitting waiting for 3 months for this product to show up. And so that's part of the challenge. But anyway, I forgot what your question was. I just got sidetracked.
You answered it. You answered it. I was just wondering how many of the
how many
construction. Yeah,
because customers want you to handle the construction. They get in bed with you. They really like the experience with water, and then you're done. And clients really don't like being just left on their own to figure it out. So that's why, and when we're continuing to scale up that department as we speak. We just hired 3 more project managers to take. A PM can bring in $1.5 million to $2 million of top line revenue in their book. So it's all a multiple of that.
Mm-hmm.
And an average job is about $26,000. Gross profit should be about 48% for us, and you should be bringing home 20 cents to the bottom, from the bottom line out of every dollar. So it's just taking arithmetic and saying how much volume do we have up top, and then that just drops down.
Post acquisition, did the private equity company do anything at all?
Did they?
Yeah, did they do anything at all to the business? Did they?
Yeah, that was the toughest part, and I think this happens to a lot of companies. Integration. So after you get acquired, there's obviously an integration process, which will typically involve accounting. So we use QuickBooks. No more QuickBooks. They took away. I got into an argument with the CEO, and I'm like, you just took away my cockpit. I know how to read my gauges. I know how my chart of accounts are set up. I know what percentage of revenue each expense category should be. Fuel should be 3.5%. If it goes over, something's wrong. Somebody's stealing fuel from me. Like, I knew it like the back of my hand. And so when they changed us into a new accounting system and changed our chart of accounts, that's something I didn't expect, and so that was pretty painful. They changed our payroll system. Not the end of the world. They went to ADP, but that required a lot of change. They changed our, I'll just call it our CRM, our operating system for our company. That was very painful because they didn't understand, and I gave them a lot of feedback. I said, when you go to change somebody's operating system, meaning the software, there's a lot of SOPs that have to change. A lot. And if that company is not ready to rewrite the playbook, you can have what happened to us, which is we started struggling with revenue because there was so much chaos with the changing of softwares and the new apps and the new way of doing everything. And while you're trying to maintain revenue and EBITDA, so my feedback to them was, when you acquire a company, and maybe this will help you, do not build in growth for their first year. Do not expect them to grow. But they expected us to grow our EBITDA by $1 million the first year they acquired us while doing all this integration work. And I'm like, bad move. Because then you're making me get pissed off because I don't like losing, but you're stacking things against me that make it very difficult to pull off a EBITDA growth while going through integration. So there was that. And then there's just what everybody thinks. You just sold your company. What's the dialogue? How did you present that information to your company? And then are you going to have management buy into the new changes? So I wound up having to fire my right-hand man, my brother-in-law, which was very painful because he couldn't handle the changes and he just couldn't figure it out. And so the CEO called me, he said, hey, you need to fire him tomorrow morning.
Wow.
That was very painful. It's my sister's husband, my nephews and nieces. It's,
Yeah.
So I did go through some pretty painful things. And one of the hardest things that I had to go through was standing in front of my company and telling them that I'm stepping down. I mean, that was a very emotionally, I've never been so nauseous and sick and nervous to speak in front of anybody than I was in that moment. And the CEO from the private equity group flew down, and because he said, you need to do it. You can't keep beating around the bush, and you just got to rip the Band-Aid off. So that was pretty challenging for me too. But having gone through it and looking in the rearview mirror, I'm like, whew, I'm so glad I got through that, dude.
How long post acquisition?
I mean, shit, I waited until 4 months ago to really have an honest, sincere explanation to everybody and apologize for all the pain that everybody's gone through, because everybody thought, which is what most employees will think, is all the problems going on are because of the private equity group.
Yeah.
And so they come up with this storyline that says everything's changed. I want to go back to the way it used to be. Ben's a sellout. They come out with all these different things.
Yeah.
And so I had to really reset the foundation in the company and get them headed in the right direction. And then I also had to announce that Nick was going to be running the entire company now, and I'm not, and I won't have an office here. But It's all behind us, and now the company is doing great without me.
So that J curve it took, in during that transition, that's midway in late 22 into 23. So essentially 23 is where the J curve happened.
Yeah, when I sold my company in November, first of all, as soon as the money hit my bank account, which is shocking, but I felt no emotion. There was no excitement. And I got from so much stress getting this deal done, it made me physically ill. I was bedridden for like 3.5 weeks. I couldn't get out of bed.
Wow.
And I mean, I was physically and emotionally and mentally exhausted by the process. But then I remember walking in my building, because you remember, you got Thanksgivings and you've got Christmas and then you got New Year. And now I'm walking in my building to a company I don't own anymore. And like, that was a very emotionally difficult process for me. And reporting to people. I learned that I don't like reporting to people.
Yes.
You know, it's just not in my, I can't deal with it. And so anyway, it's a big process to go through. And then there's the aftermath of what's life like after you've let go of your baby, and how do you use your time? And there's I went through a deep depression. Because it's not all rainbows and butterflies. You think, oh man, you got $40 million. That's, yeah, I went out and bought some fancy cars, Lamborghini and Rolls Royce, and I'm doing all this stuff. But I actually got really clinically depressed because I felt lost and didn't know what the hell I was going to do with my time. And that's actually how I found GoBundance, was that I knew I needed to be surrounded by people that had maybe gone through it and that were strong men, and that I could kind of lean on through the emotional transition period of what's my next chapter look like. And frankly, I'm still figuring that out. But I'm getting closer, because there's just, anyway.
Yeah, I think it's just an emotional J curve. You go through it, and everyone takes some certain amount of time and certain amount of process to get over it. But in that 23, did you sustain the revenue number, or you were down a little bit?
We were down a little bit. Yeah, we were down. And they were pissed because they're like, dude, we freaking underwrote you at this.
Yeah.
And you guys are like, you can't do this.
Yeah.
Because they're reporting to a board and getting heat on them.
Yeah.
Like, you guys made us stroke a check to Surdi, and now look at it, and they were pissed. But anyway, yeah, so we kind of hit this challenge point where revenue started dropping and EBITDA started dropping, and it took us a year, because I think January of 2024 was when we really started getting back on our feet and hitting our revenue targets again. And it's very mentally defeating to have these revenue targets and not be hitting them.
Yes.
And looking at the books and just not being able to figure out why the hell your EBITDA number is what it is. And then, like I said, they changed the whole dashboard. So I'm like, I would get pissed and just slam my hand on the desk and be like, we figured it out. But
got it. So what was the logic for them to make those drastic changes, especially, like an operating system? You were on Service Titan, right?
Yeah, Service Titan for the carpet cleaning company, but then we were on a different platform for the water damage.
Similar.
It's kind of a complex setup. But look, I mean, they're smart guys. They know that the next buyer that's coming down the pipeline, they want to be buying a very systemized company that, so we use Power BI. They brought in Power BI. They had some very smart integration people that came in. They're like, we need all the data to be coming in from every company. It needs to feed up to Power BI. And this dashboard that we show these investors, it's got to be tight, And they knew that it all had to report up to one common P&L, and each brand had to have their own P&L that had the same chart of accounts and the same thing for them to get the highest multiple that they could. you know, their plan was to sell at 40 million EBITDA, and but to get the multiple, it can't just be a bunch of companies that you bought. You know what I mean? Like
Yeah.
any to go buy $40 million worth of EBITDA and just hold them in a holding co, but that doesn't really get you the multiple.
Yeah. And their multiple is at 20 at that level, at 40 million?
They projected anywhere from 14 to 18 multiple if they were going to be at the 40 million. We've now surpassed 40. I think we're at 56 million EBITDA.
Nice.
But you have to show organic growth. If you're just an acquisition machine,
Yeah.
it's just not attractive, you know. So they had to figure out a lot of supporting these brands organically growing while also doing acquisition growth. And so now we're entertaining offers at the 22x multiple,
Nice.
which is bonkers, you know.
Yeah, it's public. Yeah, it's public. It's like going public. Pretty
Yeah.
much. Yeah. So are you what's the rate of growth that's organic growth that's kind of acceptable, if you will?
They wanted 15% organic growth
Got it.
every year, and historically we grew at 60% every year. And so to me, I looked at it, I'm like, no big deal, dude. I can do that in my sleep. And so I built my bonus structure around smoking their 15% growth goal. And then, yeah, I wound up being humbled by the process there. But
got it. So going into to the transaction, you were planning on staying for the whole ride.
I plan on staying, and that was going to be my career, and that I'd work my way up in the corporate ladder and maybe become a regional VP. And, you know, and then I think I just kind of listened to my heart and listened to, I just looked at it like, man, you've spent 17 years of your life putting the business first, and marriage and children and everything kind of came second almost to that. And so I kind of took a step back and just said, you know, this next chapter, I'm going to put my kids and my wife first. And that's when I changed, realized I'm going to step down and not pursue this corporate, you know, ego driven thing, you know?
Yeah. That makes complete sense. So, you know, going back a little bit in terms of that, what made the business so attractive to these guys? You know, you had those 7 elements. Are there any elements in there that make that business attractive and get the highest multiple?
Yeah. So I think, like if I were going to partner with somebody and we wanted to go to market and sell that company, the thing that we would be doing is, they're going to want to look at your SOPs. They want to see what the ingredients are of your company, you know? And so it's making sure that you have a documented system for how your soup is made. You know, they want to know how is this actually happening. I hired a PR firm before I went to market, and I made sure that I was hitting Inc. 5000. A lot of people are like, what's Inc. 5000 really matter? But what you don't realize is a lot of these PE firms are pulling people from those lists because they're sustained growth monsters. They want those companies. So, and I've talked to a lot of business owners that didn't even know about Inc. 5000 or how to qualify for it. They thought they just got a phone call from Inc. 5000 and said you made the list. I'm like, no, dude, you apply for it.
Yeah.
And you submit your financials. And I said, so the sooner you get on that list and can show that sustained growth structure, that is very attractive. And that's kind of the swimming pool that these guys are searching in.
Yeah.
A lot of the time. So I'd say make sure that you get on that Inc. 5000 list, or if you have a local, like for us, it was the Puget Sound Business Journal fastest growing companies list. Get on that thing. And it's also exciting for your culture to be part of a very rapidly growing company. But I hired a PR firm, and I made sure that I said, get us everywhere. We'll get stories written about us in the Seattle Times. I want them all over the place. Get us picked up on Yahoo Finance. Get us everywhere. Because I wanted to really ring a bell in the marketplace, and it worked. It got us a lot of attention, and people started noticing, and a lot of people knew who PureDry was on a national basis and not just a local.
Nice.
And so I think that that's part of it too. And my company was just packaged very well. The branding, you know, the branding package, meaning website, how your vans are wrapped, your uniforms of your employees, all your internal systems. If any of us were buying a company, we look at a company that looks like that, that for us, we're probably going to pay a little bit more for that company because we're not going to have to put in all that sweat to rebrand everything and do all this shit, you know?
Yes.
And so I think do that in the early game. Hire Dan Antononi with Kick Charge Media. Get your branding dialed. Look like a $1 billion brand before you are. And again,
Brett, it's called Kick Charge. Kick Charge Media. He's a well-known guy within the home services space.
Correct.
I think we have a couple of GoPros that are working with him right now. He's not cheap, but he seems to be doing well.
He's not cheap, but he's the king of branding, and he gets it.
Yeah.
And so
he has a really good YouTube video if you look him up. What's his name again?
Dan Antononi. I don't know if I pronounced.
There's a good YouTube. Yeah, if you put Dan and you put Kick Charge, the video will pop. He does a good presentation.
Yeah.
Sorry, but I think it's so powerful because if these guys are taking a deal to a board, taking a deal with a board that's Inc. 5000, that's this makes it a lot easier to get approved especially at that high multiple than if it's not. Than if it's a white van, no name, shitty website, shitty everything.
Exactly. Yeah, because they look at that as an operating expense that they're going to have to take a hit on. And so that goes into it. But the 7 things that I wrote down are understanding your tax strategies before you sell. Holy moly. The biggest impact in the stripping of your wealth is going to happen taxation. And had I known before I sold what some of the things that I should have done are, I would have saved myself millions and millions of dollars. Meaning setting up your trusts ahead of time, having seasoning in those trusts, selling your, like in Washington, we have Washington state capital gains of 7%. If I would have known that before I sold, I would have saved 7%, several $1 million I would have saved. So I always tell people, understand the tax strategies before you go to market, because you may need seasoning and you may need like, for example, if you change yourself to a C Corp, like you can avoid capital gains tax altogether. There's some
QSVS.
I mean, and I didn't know that. And if I would have known that before I sold my company, my tax bill was $9 million or something. I mean, that's like a huge deal. So know your tax strategies is what I would tell people. Time commitment, selling companies, obviously time consuming. And we already talked about that, but anticipate spending several months, in that process. And we talked about having a strong operating team. Having a competent, reliable operating team is essential, not only to increase EBITDA value of your company because they can see your company operates without you, but to take the weight on their shoulders while you're going through this process, correct valuation, understanding the true value of your company is pivotal. And I think the only way you can really figure that out is by getting an investment banking firm to come in and audit your company and figure that out. I talk to a lot of people selling their company and they think they know what it's worth, but that could be a multi-million-dollar wrong assumption. Market timing is something that I wrote down. The market conditions can significantly impact your company's sale price. And I think they say it's like catching a falling knife. You can't time the market, but you can certainly look at economic influence and get inside intel into what is happening in the multiples of your industry. And I timed it perfectly is the lesson of it. Like I knew what I was sitting on. I knew the timing of it, that if I was going to sell, I knew that I had to sell now. And that if I waited, I might be able to sell I could have gotten my EBITDA up to, let's say, 6 million. But if the market shifted, it's like, damn, but you didn't even make as much because so knowing the market timing, I think is important. And then build your post-sale team, pre-sale. The complexity of selling to a private equity group necessitates professional advice. I would engage legal and financial experts familiar with mergers and acquisition to navigate the intricacies of the deal. I brought in consultants and stuff in preparation for selling my company. And I think that it paid itself very wisely. We talked about how important it is to get an M&A banking firm. I would figure out a wealth manager before you do it. Like, I was late, dude. I sold my company and then I'm like, I need a wealth manager. I need this, I need that. So if I could do it all over again, I would have gotten my estate and tax and wealth managers in a room, and that we strategically talked about how we're going to approach the sale. How much are you going to roll over? Yeah.
You froze. Uh-oh.
He never mentioned what that wealth management or rest making firm he used was, did he?
My connection
No.
dropped.
Oh, no, go ahead. You're good now. Charlie, you said you're talking about the M&A advisor or the...
Yeah, did you ever?
M&A
I didn't hear
advisor.
that. I used to kick
Who's
charges
the
with quite
M&A
a few
advisor
others.
that you used? Or the firm that you used?
I used a firm called Alexander Hutton.
Alexander Hutton. Okay. And they do like middle market, small to middle market?
They do all kinds of stuff, but I think that's a crucial decision. And so it's get feedback and make sure that you're using somebody is used. Am I coming through okay, you guys? Because it's saying
we can hear you now. Yeah.
Can you see me?
Yes.
Right.
Yes.
What I was trying to say was the emotional preparation is, what do your kids and your wife need to know about what you're about to go through too? It's emotionally draining, and if they're not prepared for it too, I think that can be something to consider as well. So
yeah, it's huge. Well, especially if you're like, you were down and in bed for 3 weeks after. That's
yeah, you just
sure
need
they
a
felt it.
lot of emotional support. I'm probably not going to bring the garbage out, every morning. Like, I need some
Yeah.
some time here, but anyway.
So the trust piece. So tell me a little bit more about. I know the QSBS component, but tell me about the trust. How would you have used trust to be more tax efficient?
Well, there's a lot of strategies you can do, and one of them is that you can, like what we're doing now in preparation for the second buy of the apple, is essentially selling the stock that I own in this group to a spousal limited something trust. I'm not an expert in it, but
Okay.
a slant. And we're placing that slant to be based out of Nevada.
Okay.
And so there's gifting. You're allowed to gift a certain amount of money in your lifetime. I don't know the exact number, but I want to say it might be like 5 million or 10 million or something like this in your lifetime, a gift exemption. And so knowing that, we're harnessing some of that estate law to get money out of my personal benefit and into a trust to avoid the Washington state capital gains. Now, not everybody lives in Washington, but if you live in California, if you live in New York, if you live in some of these higher taxation states, you need to start thinking about, where am I moving this prior to selling? There was a strategy. I also hired the wrong estate people too. Like, they wanted me to set up shit, I can't remember the name of it. It's basically a trust for donating money. And if you have the proceeds from the sale go into this trust that's supposed to be designated for donating money, you avoid the tax, but then you can't access the money. But I was this close to going with that until I met a new Crescent Financial, and they're like, dude, you're way too young to do a strategy like that.
Yeah.
It's, and so I learned a lot about all that kind of stuff post sale too, and spent hundreds of thousands of dollars in mistakes and learning all that,